We all love to get paid, but what are those taxes that keep getting taken out of our paychecks? Today, I'm going to answer this question and reveal all the mysteries surrounding this issue. So without further ado, let's dive in. If you're someone who receives a paycheck, then you might have noticed that money gets taken out of your paycheck every single pay period. It freaking sucks. And many people are shocked to discover how much money is actually being taken out of their paychecks and going somewhere, whether it's to the government or somewhere else. When money is taken out of a paycheck, it is because an employer is withholding amounts that it is obligated to pay to the government on your behalf for taxes. So here are some of the different taxes that the money taken out of your paycheck goes towards. Number one, federal income taxes. Federal income taxes are taxes that you owe to the government based on how much money you earn and what tax bracket you fall into. The federal income tax rates ranges from 10% to 37%. However, you will only have to pay the 37% tax rate if you make over $626,350 in 2025. The vast majority of Americans don't fall into that bracket. If you're a W-2 worker, then your employer will take the money that you pay in income taxes out of your paycheck every pay period. Your employer sends the money that it takes out of your paycheck to the federal government to cover your federal income tax liability. Now, what about state income taxes? Just as you have to pay taxes to the federal government, many state governments also require you to pay income taxes. However, not every state has income taxes. For example, Florida, Texas, Nevada, Wyoming, and a number of other states have zero income taxes, which is nice. So if you have to live in a state that does not levy state income taxes, then you will not have to pay these taxes taken out of your paychecks. Now, it's important to know that the income tax rates can vary tremendously from state to state. Some states such as California, New York, New Jersey, and Hawaii have extremely high income tax rates. In fact, the top tax rates in all of these states is over 10%. The tax rates are lower in many other states. If you're not a multi-six-figure or seven-figure earner, then you can expect to pay between 2 to 7% in state income taxes on average. But what about Social Security taxes? The Social Security tax is a federal payroll tax in the United States designed to fund the Social Security program, which provides financial support for retirees, people with disabilities, and survivors of deceased workers. As of 2025, employees pay 6.2% of their wages towards Social Security, and their employer matches this amount, contributing the other 6.2%. So if you're a W-2 worker, then 6.2% of your paycheck goes to this tax. The rules are different for self-employed people. The full 12.4% is paid directly by the individual. However, this tax only applies to income up to a certain limit, $176,100 in 2025. Any earnings above this cap are not subject to Social Security tax. Social Security taxes are automatically deducted from your paycheck. These contributions go into the Social Security Trust Fund, which distributes monthly benefits to eligible recipients. While you pay into the system throughout your working life, the amount you receive in retirement depends on how much you've earned over your career and when you choose to start collecting benefits. The Social Security tax is a critical part of the United States social safety net, ensuring that people have at least a basic level of income support later in life or in the event of disability or death. Medicare Tax. Medicare Tax is a federal payroll tax that helps fund the Medicare program, which provides health insurance primarily for people aged 65 or older, as well as for some younger individuals with disabilities. As of 2025, employees contribute 1.45% of their wages towards Medicare, and employers match that amount, bringing your total contributions to 2.9%. Self-employed individuals are responsible for the entirety of the 2.9%. Unlike Social Security tax, there is no income cap for Medicare tax. All earned income is subject to it. Additionally, there is an extra 0.9% Medicare surtax on higher earners. This surtax applies to individuals earning over $200K or $250 if you're married filing jointly. But unlike the base Medicare tax, employers do not match this extra amount. It's paid only by the employee. Medicare taxes are deducted automatically from paychecks and are used to fund Medicare Part A, which is hospital insurance, which helps cover inpatient care, skilled nursing facilities, and some home health care. And these contributions ensure access to essential health services for millions of Americans as they age or face serious health challenges. What about local taxes? Local taxes are taxes imposed by cities, counties, or other local governments to fund services such as public transportation, schools, emergency services, and infrastructure maintenance. Unlike federal and state taxes, which are broad and apply across wide areas, local taxes are geographically specific and can vary significantly depending on where you live or where you work. Common types of local taxes include property taxes, sales taxes, and special district taxes. For example, some cities like New York City require residents working in the city to pay a local income tax. Local income taxes are often a small percentage of your earnings, but they can still have a noticeable impact on your paycheck. They usually are withheld by your employer, just like federal and state taxes are withheld. The rules for local taxes can be complex because they're governed by the local jurisdiction laws, which means your tax responsibility may often differ depending on where you live versus where you work. In some places, you might pay local tax to both your home city and the city you commute to for work. These taxes help fund the services you rely on every day in your community, making them an important part of the overall tax picture. Now, what about other payroll withholdings? In addition to all the money that is withheld from your paycheck for tax purposes, there could be a number of other things that money is being withheld for from your paycheck. Here's a quick list of some of the items that could be withheld on your paycheck. 401k contributions. 401k contributions are amounts of money that you choose to set aside from your paycheck to save for retirement before taxes are taken out. When you contribute to a 401k, money goes into a special retirement account. It lowers your taxable income for the year since contributions are made pre-tax and grow tax deferred, meaning you don't pay taxes on the investment gains until you withdraw the money later on in retirement. Let's go over an example. Let's say if you earn $60,000 and you put $6,000 into your 401k, you're only taxed on $54,000 that year. Importantly, many employers offer a match, which means they will match your contributions up to a certain percentage of your income. If your employer offers a match, it can be extremely beneficial towards helping you boost your retirement savings. Health insurance premiums. If your employer offers an employer-sponsored health plan, then the amount of money you are responsible for in terms of the premiums can be taken out of your paychecks. Employer-sponsored health plans are health insurance plans that an employer offers to help employees cover medical costs like doctor visits, hospital stays, prescriptions, and a lot more. The employer negotiates and buys the insurance from a provider such as Blue Cross or United Healthcare, and typically it covers a big chunk of the cost, while you pay the rest through paycheck deductions. HSA contributions are another thing to be mindful of. HSA contributions are the money that you put into a health savings account, which is a special tax advantage savings account used to pay for qualified medical expenses. HSAs are available if you're enrolled in high deductible health plans, and they're one of the most tax-friendly tools out there. Here's what makes HSA contributions so awesome. 1, pre-tax contributions. The money goes in before taxes, lowering your taxable income. Number 2, tax-free growth. Any interest or investment gains inside the HSA are not taxed. And number 3, tax-free withdrawals. As long as you use the money for qualified medical expenses like doctor visits, prescriptions, etc., you don't have to pay taxes when you take the money out. Many employers will allow you to contribute to these accounts through payroll deductions. What about union dues? Union dues are regular payments made by workers who are members of a labor union, used to fund the union's activities and operations. These dues help cover things like collective bargaining, legal representation, grievance handling, and organizing efforts to protect workers' rights and negotiate better wages, benefits, and worker conditions. The amount is usually a small percentage of your paycheck and is often automatically deducted, and paying dues gives members access to union support and resources. It also helps to keep the union running effectively and efficiently on behalf of its members. Now, before we wrap up this video, I just want to remind you guys to sign up for the Tax-Free Wealth Challenge that will be taking place August 4th through August 8th. In this event, I'll be teaching business owners who are making at least $500,000 per year how to dramatically reduce their tax burden using advanced tax strategies. So if you're a self-employed business owner, you have an LLC or an S corporation, you're making over $500,000, and you would like to cut your tax bill by 50 to 100%, then be sure to sign up for this digital tax conference. The link is below in the description. Okay, that's all I got for today. As always, don't forget to like, comment, and subscribe to the channel. I will see all of you guys on the next video. Cheers.